Welcome back to Money Talks, your guide to the Canadian Securities Course. I'm your host, Rita, and it's fantastic to have you with us again. A huge thank you to our loyal listeners for your continued support. And if you're new here, welcome. Do us a huge favor and hit that subscribe button, leave a rating, a comment, and share this episode with your friends. It genuinely helps us bring more valuable content to light, aiding your financial education and career path right here in Canada. Speaking of helpful content, don't forget to head over to mtalks.ca to download our free, concise study guide to help you prepare for the CSC exam. And for those of you aiming to ace the exam, we have a complete study guide with mock tests covering both Volume 1 and 2. Today, we're diving into a topic that has reshaped the investment landscape: fee-based accounts. And to help us unpack this, I'm thrilled to welcome a special guest to the show for the first time. Hey, Rachel, great to have you on the show. Thanks for having me, Rita. It's a pleasure to be here. Rachel is a seasoned tax and financial professional who has worked with a wide range of retail and institutional clients in the financial field. So, Rachel, with all the buzz in the market, let's jump right in. For our listeners, what exactly is a fee-based account and why has it become so popular? That's the perfect place to start. A fee-based account is essentially a different way of paying for financial advice. Instead of the traditional model where an advisor is paid through commissions on the products they sell, a fee-based model bundles various services for a fee that's typically a percentage of the assets they manage for you. Think of it like this. The old commission model is like paying a mechanic for every single part and every minute of labor separately. You might wonder if you really needed that extra part. The fee-based model is more like paying a flat fee for a comprehensive maintenance package. The focus shifts from individual transactions to the overall health and performance of your car, or in this case, your portfolio. That's a great analogy. So what's driving this shift, especially with high net worth clients? High net worth clients are looking for more than just stock picks. They need a holistic approach that includes risk management, estate planning, and retirement strategies. They also want their advisor's compensation tied to the performance of their portfolio. If the portfolio grows, the advisor's fee grows. If it shrinks, so does their fee. This aligns everyone's interests. Plus, it offers greater transparency. The fees are clearly laid out on your statement, which builds a tremendous amount of trust. That makes a lot of sense, but it can't be perfect for everyone. What are some of the potential downsides? You're right, it's not a one-size-fits-all solution. One of the main disadvantages can be the potential for higher costs, especially for a buy-and-hold investor. If you don't trade often, you might be paying for services you're not fully using. Some accounts might also have a limit on the number of trades. And while it's rare with reputable advisors, there's a potential for neglect since the income stream is steady. Plus, you have to watch for extra fees. For instance, some investments, like mutual funds, have built-in fees. So you could end up paying a fee on top of a fee, though regulations have cracked down on this. It sounds like it's crucial for listeners to really think about their own investment style before jumping in. So, for those who decide a fee-based structure is a good fit, what are the main types of accounts they'll encounter? Broadly, they fall into two categories: managed accounts and non-managed accounts. The key difference is who makes the investment decisions. Let's start with managed accounts. What does that term mean for the average investor? A managed account is a portfolio owned by an individual investor, but looked after by a professional money manager. A key feature here is that you give the manager discretion to make investment decisions on your behalf. This is what we call a discretionary account. It's perfect for someone who lacks the time, expertise, or desire to manage their own portfolio day to day. So you're essentially hiring a professional to be the pilot of your investment portfolio. Exactly. And within these managed accounts, there's a whole spectrum of options. The most accessible are mutual fund wraps and exchange-traded fund wraps. Imagine a professional chef creating a curated meal for you, but instead of food, it's a selection of different mutual funds or ETFs bundled into one account. An overlay manager is the one who puts this selection together and makes ongoing adjustments. I see. And for someone who wants an even more personal touch, Then you might look at an advisor-managed account. Here, your personal advisor is also a licensed portfolio manager who builds and manages a portfolio model tailored to you. It can be more cost-effective since there are fewer parties involved. As your assets grow, you get access to more sophisticated options like separately managed accounts, or SMAs. With an SMA, a dedicated, often institutional-grade portfolio manager invests your assets for you. But here's the key difference from a mutual fund. You directly own the individual securities. Think of it like having your own private garden tended by a master gardener, rather than owning a plot in a community garden. This allows for incredible customization. For example, you can exclude certain stocks for ethical reasons, and it provides significant advantages for tax law selling. Rachel, this is incredibly insightful. The way you're breaking down these complex topics is so helpful. For our listeners, if you're finding this breakdown on fee-based accounts valuable, please take a moment to subscribe and share this episode. It helps us reach and empower more people on their financial journey. Now, Rachel, you were just explaining the high degree of customization with SMAs. What happens when an investor's needs are even more complex? That's where we see the evolution into multi-mandate managed accounts, often called unified managed accounts, or UMAs. A UMA is like having a general contractor for your entire financial house. It consolidates all your different investments, stocks, bonds, various SMAs, into a single account. The overlay manager plays a crucial role here, almost like an orchestra conductor, ensuring all the different portfolio managers, the sub-advisors, are working in harmony to meet your overall financial goals. For the ultra-high net worth, there are even more comprehensive solutions like household accounts and the private family office. A household account coordinates investment strategies across an entire family's various accounts to optimize tax management and overall financial goals. A private family office is the pinnacle of service, where a dedicated team of professionals, lawyers, accountants, investment managers, handles every aspect of a family's financial life. It's amazing how tailored these services can become. Now, what about the other side you mentioned, the non-managed fee-based accounts? Non-managed fee-based accounts are simpler. You have your full-service brokerage accounts, where the fee covers financial planning advice and a set number of trades, but you, the client, still make the final call on what to buy and sell. Then you have the rise of self-directed brokerage accounts offering fee-based models. A particularly interesting development here is the Robo-Advisor. Robo-Advisors use algorithms to build and manage a diversified portfolio for you, typically using low-cost ETFs. Robo-Advisors are everywhere now. What are the big pros and cons there? The main advantages are the low cost and accessibility. Management fees are often under 1%, and you can start with a very small amount of money. They're fantastic for new investors or those who prefer a completely hands-off digital experience. The downside is that it's a one-to-many service model, so you don't get that deep, personalized financial planning that a dedicated human advisor can provide. This has been an incredibly comprehensive overview, Rachel. So to wrap it all up, what's the one key question our listeners should ask themselves when considering a fee-based account? The most important question is, what level of service and involvement do I truly want? Are you a hands-on investor who just needs a platform for occasional trades? Or do you want a dedicated professional managing the complexities for you? Your answer will guide you to the right type of account. The beauty of the Canadian financial market today is that there is a solution for almost any type of investor. Fantastic advice. Rachel, thank you so much for sharing your expertise with us today. It's been a real pleasure. The pleasure was all mine, Rita. Thanks for having me. That's all the time we have for this episode of Money Talks. A big thank you to Rachel Underwood for demystifying the world of fee-based accounts. And don't forget to visit us at mtalks.ca for your CSC exam study guides. Join us next time as we continue to explore the ins and outs of the Canadian securities landscape.